Your neighbor just made $200,000 flipping a house. Your coworker's stock portfolio doubled in 2 years. And you're stuck wondering which path leads to actual wealth. Here's the truth nobody talks about. Choosing between real estate and stocks isn't just about returns. It's about matching your investment to your life, your personality, and your financial goals. Today, we're breaking down everything you need to know to make the right choice for you. Let's start with what everyone wants to know. Which one makes more money? The stock market has historically returned about 10% annually over the long term. Real estate? It depends on who you ask. Some studies show 8 to 9% annual returns. But here's where it gets interesting. Real estate investors often leverage debt to amplify their returns. If you put down 20% on a property and it appreciates 5%, you've actually made 25% on your initial investment. That's the magic of leverage, and it's something you can't easily replicate with stocks. But before you run out to buy a rental property, let's talk about the stock market's secret weapon: compound growth without effort. Warren Buffett didn't become a billionaire by constantly buying and selling. He bought quality companies and held them for decades. Your stocks work for you 24/7, gaining value while you sleep, while you're on vacation, while you're doing literally anything else. Here's where things get real. How much time do you actually want to spend on your investments? Stocks are the ultimate passive investment. You can build a diversified portfolio in an afternoon, set up automatic contributions, and check in quarterly. That's it. You're not fielding midnight calls about broken water heaters or spending weekends comparing property management companies. Real estate demands your attention. Even with a property manager, you're still the business owner. Tenant issues, maintenance emergencies, property taxes, insurance claims. One investor I know spent 3 months dealing with a tenant who turned their rental into an unlicensed dog breeding operation. Try getting that smell out of carpet. But here's the flip side. That hands-on involvement means control. You can force appreciation by renovating. You can increase cash flow by improving operations. You can't call Apple and suggest they redesign the iPhone, but you absolutely can add value to a property through strategic improvements. Let's say you need $50,000 next month. Emergency medical bills, unexpected opportunity, whatever the reason. How fast can you access your money? With stocks, you can liquidate your position in seconds. Click, click, sold. The money hits your account in 2 business days, done. Real estate? You're looking at months under the best circumstances. Sure, you could try a quick sale, but that usually means leaving tens of thousands on the table. You could tap a home equity line of credit, but that means taking on more debt and going through an approval process. In an emergency, real estate is about as liquid as concrete, which is literally what it's often made of. This liquidity difference isn't just about emergencies. It affects how you can respond to opportunities. When the market crashes and stocks are on sale, you can jump in immediately. When real estate prices drop, you need to have cash ready or navigate financing while everyone else is doing the same thing. Both investments offer tax advantages, but they play completely different games. Real estate investors get depreciation, which is basically the government letting you pretend your property is losing value even when it's appreciating. You can deduct mortgage interest, property taxes, repairs, and if you're strategic about it, even that trip to check on your out-of-state rental. The 1031 exchange lets you roll gains from one property into another, deferring taxes potentially forever. Stock investors get the long-term capital gains rate if they hold for over a year, which is lower than ordinary income tax rates. You can harvest losses to offset gains. And if you're holding stocks in retirement accounts, you get tax-deferred or even tax-free growth. Here's the kicker. Real estate's tax benefits are front-loaded. You get deductions now while you're working and in a high tax bracket. Stock market gains are backloaded, which can actually work beautifully if you're planning to retire in a lower tax bracket. Let's talk about putting all your eggs in one basket. With $100,000, you could buy one rental property in one neighborhood in one city. That's concentrated risk. If that neighborhood declines, if a factory closes, if local politics turn hostile to landlords, you're stuck. That same $100,000 in the stock market can buy you pieces of hundreds or even thousands of companies across every industry and country. When tech crashes, maybe healthcare rallies. When the US market struggles, perhaps emerging markets thrive. But real estate investors counter with this. You can directly inspect what you're buying. You can't tour Apple's balance sheet and kick Amazon's tires, but you can absolutely walk through a property, assess the neighborhood, and meet the tenants. There's something powerful about investing in tangible assets you can touch. Inflation is eating away at your purchasing power right now. Which investment protects you better? Real estate is often called the perfect inflation hedge. As prices rise, so do rents. Your mortgage payment stays fixed while your rental income increases. Your property value typically rises with inflation. You're paying back that loan with cheaper dollars every year. Stocks are more complicated. Some companies thrive during inflation because they can pass costs to customers. Others struggle. Overall, stocks have historically outpaced inflation, but the ride is bumpier than real estate's steady climb. Nobody talks about this enough. Investing is psychological warfare with yourself. Stock investors face daily temptation. You can check your portfolio value every 5 minutes. When the market drops 20%, you see that loss in real time, and every fiber of your being screams, sell. Most investors buy high and sell low because they can't handle the emotional roller coaster. Real estate investors don't see daily price quotes. Your property is worth what it's worth, and you won't know for sure until you sell. That lack of minute-by-minute feedback is actually a feature, not a bug. You can't panic sell at 2 a.m. because you saw a scary news headline. But real estate brings different emotional challenges. Difficult tenants can make you question everything. Property emergencies create stress that number on a screen never will. There's something viscerally frustrating about getting a call that your rental's basement is flooding. Starting with stocks is almost absurdly easy now. Many brokers have zero minimums. You can literally buy fractional shares of expensive stocks with $10. The barrier to entry is basically just having a pulse and an internet connection. Real estate demands serious capital up front. Down payments, closing costs, inspection fees, immediate repairs. Even if you're putting down just 20%, that's $60,000 on a $300,000 property, plus another $10,000 to $15,000 in closing costs and reserves. And that's assuming you qualify for financing. This high barrier actually creates opportunity because real estate is harder to access, there's less competition, and potentially more room for savvy investors to find deals. The stock market is ruthlessly efficient. That fixer-upper in an emerging neighborhood, that might be genuinely undervalued. How do you grow each type of investment? Growing a stock portfolio is linear and simple. Make more money, invest more money, rinse and repeat. Your buying power is limited to your capital. Real estate investors can scale using other people's money. Once you have one successful rental, you can use that equity to buy another, then another. Each property can become leverage for the next one. That's how people build multi-million-dollar real estate empires, starting from a single rental property. But scaling real estate also means scaling complexity. Each property adds management burden, risk, and headaches. Scaling a stock portfolio just means buying more stocks. So which one is right for you? Choose stocks if you value simplicity, liquidity, and true passive income. Choose stocks if you have limited capital to start, if you want instant diversification, or if you prefer not to deal with tenants and toilets. Choose real estate if you want control, if you enjoy the hands-on aspect of building something tangible, if you can handle illiquidity, and if you have the capital to make a serious commitment. Choose real estate if you're good with people, don't mind occasional 2 a.m. emergencies, and see yourself building a property empire. But here's the secret successful investors know. This isn't an either-or question. The wealthy don't choose between real estate and stocks. They use both, playing to each investment's strengths while minimizing weaknesses. Maybe you start with stocks while building capital, then add real estate once you're ready. Or maybe you buy your primary residence for stability while building wealth in the stock market. If this breakdown helped you, hit that subscribe button and let me know in the comments. Are you team real estate, team stocks, or team both? Your financial future is waiting. Make the choice that fits your life.